We've had some phenomenal failures that we wish we could have back. It's just a question of learning from what happened, what did we miss, and what could we have caught earlier? Was this kind of a black swan event where nobody was expecting it and we were just unlucky?
At Context Ventures, our podcast Advancing VC covers all things startup and venture capital, primarily how venture capital is changing from the emerging manager perspective. We'll be talking with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, Lenore and I will be interviewing our guest, Ned McGuire, a managing director at Wilshire. Ned, thank you so very much for taking the time to chat with us, especially as it's right before the holidays. Can you please share your background and how you got to do what you are doing now at Wilshire?
Great. Thanks, Tim and Lenore. It's great to be with you, and happy holidays to everybody. At Wilshire, I'm the head of asset allocation right now, so I look over a lot of the strategic asset allocation projects for our large institutional investors. Now, prior to Wilshire, I probably have a slightly unique path, as does everybody. I got a graduate degree in operations research from the University of North Carolina at Chapel Hill in the early 2000s. Since I've graduated, that program has actually been married with the statistics department, so there's no longer an operations research degree that you can get, but you can get one through the statistics department. After school, I needed a job. And when I was in college, I knew of people who became actuaries. And so I knew that I could pass exams. I knew that these were math-based exams. And so I took the first actuarial exam. I passed it. I got a job. I kept taking exams. I kept passing it. And the rest is history from there. So working as a corporate actuary for a while, working on corporate defined benefit plans, I always knew that I wanted to work in the investing landscape. And so when the opportunity arose so I could, transfer over to the investment consulting space at Hewitt, the place I worked initially, I took that opportunity in 2008. Obviously, 2008 rings a lot of bells for a lot of investors. It was a great time to start my career in the investment consulting industry at that point. Since then, first focus on largely corporate DB plans, as that was the client base at the time for my employer. But then in 2011, moved west to Wilshire Associates, or Wilshire Advisors now. Continue to work here, now eventually promoted to head of asset allocation, where I focus again on large institutional plan sponsors, both corporate, public DBs, along with endowments and foundations, and a lot of wealth channels at this point.
At Wilshire, who are your clients and how much work is involved in retaining those clients? Is this similar to the relationship that VCs have with their own LPs?
Yeah, so our clients tend to be the large public plans of the world, and large endowments and foundations and corporate plans. We also work a lot with record keepers on the wealth management side too. And so, you ask about how much work is involved in retaining those clients. And, Tim and Lenore, I think we all can agree that we work in a relationship business. And so every client that's not our client right now, we potentially want them to be our client. And so it's basically an ongoing dialogue with all the clients that we can have, and just being out there and making them aware of what our services are, learning about what they're doing and potentially how we can help. We know that we're not going to win every client, but having the conversations, ongoing conversations, learning about what they're doing and thinking about not only helps us to potentially retain them in the future, but work with our clients that we currently have.
Ned, how is competition in the space and how do you differentiate?
That's a great question. Competition is fierce. There's a lot of companies out there that have very talented people. There's no shortage of talent these days. And so the differentiation really comes in the relationships that you have with both the client and the managers that you work with. If you have great relationships with both the clients and those that you want to work with and have those who are you're investing with, that is really the way that I feel like you differentiate yourself in this industry.
Can you talk broader picture of Wilshire in terms of number of clients or number of firms you all invest in or assets under management or assets that you all advise?
Sure. So Wilshire has been around for just over 50 years now. We were founded in the early 70s. We largely work in a couple of segments. We work in a consulting segment, which I primarily spend my time with. We have close to 100 different institutional clients, spanning from public pension plans, corporate pension plans, endowments and foundations, some sovereign wealth funds, and some insurance clients too. That's really within the consulting space. On the intermediary space, we work with most of the large record keepers in the country, where they focus on servicing maybe smaller pension plans or other wealth channels too. And so that is the bulk of our business right now. Obviously, we're trying to grow that, as is most other groups at this point. We also do a fair bit in the private markets consulting industry too. Largely that marries with a lot of our institutional work, but Wilshire does have some private markets funds out there that we have put together.
How often do you meet emerging managers across asset classes? We met in the context of a venture capital, but do you meet emerging managers across all the asset classes? And if so, how are their struggles and pains similar or different?
Yeah, it's a great question, Tim. So we have an emerging manager program within the institutional consulting space. And what that is at a high level is every public market search that a client that we work with, if they have a public markets asset search happening, we try to include at least one emerging manager in that search to just get exposure and to get the opportunity out there for emerging managers. The clients can opt out of this if they want to, but to my knowledge, no client has ever opted out of having an emerging manager within the search. And so with that in mind, we always have to keep the door open to meeting with emerging managers so we can keep growing with that said, I think we perform hundreds of meetings throughout the organization with emerging managers of all asset types.
What is the best way to build the relationship with you along those lines?
I think it's, obviously performance is paramount to everything. That's the first key. But, regular communication with us and regular updates with us is great. I recognize that travel and materials are very expensive for not only emerging managers, but everybody at this point. And so just regular open dialogue and communication. If there's an update, just drop us an email, set up a call with us. But quarterly updates, if you're ever traveling to a city where we're at, just let us know. And we're more than happy usually to just sit down and have a conversation with you to hear what you're doing and what you're seeing.
How much of the appetite for the investors that you all advise, how much of the appetite has it changed for venture since you joined Wilshire? You joined them in 2011. Does it kind of mark the broader industry trends where like 2020, 2021, strong interest, and then the past 2 years, weakened interest?
I think there's growing interest, Tim, in all private assets. It's just a question, like I kicked off with, what stage of your private equity program are you in? We're all looking for the unicorns of the world. We all want to brag that we have those in our portfolio, that we picked the right managers. We all want to pick, top performing managers and funds at this point. And so, to the extent that, you see a promising manager within the venture space, you'll absolutely want them to be in your portfolio.
And within venture, especially this year in 2024, there's been a bit of a bifurcation of the firms that have been able to raise capital. And by far, the majority of the capital has been raised by the General Catalyst, the Lightspeed, the Andreessens. Do you all see at Wilshire that allocation also happening for the clients that you all advise?
Yeah, there's unfortunately there's safety in numbers and picking the biggest venture managers. I jokingly say that if you want beta in the private markets, you go to the biggest managers because they have to find the biggest deals to build their funds out. But I think there are a lot of opportunities for smaller managers to be able to get that alpha, be able to get that outperformance. It's just a question of, there might be smaller deals that the larger managers may not be able to invest in just due to their size, but they might be just as good opportunities, if not better opportunities than what's in that larger portfolio.
And beyond just performance, what else are you looking for in terms of emerging managers that may not necessarily have the longest track record?
Background, experience. It's like an interview process. You're trying to hire a manager for the long run. You're looking at their background, their history, what have they been able to do. Going back to that relationship point that I made earlier, what relationships do you have? Because as you all know in the space, if you don't have relationships with founders and inventors, you're not going to be able to invest in the promising companies of the future. And so what are your relationships? What are your networks? And a lot of it's a numbers game, but it's also a lot of, who have the quality companies come from, and do you have access to those people? And will you be one of the calls that they will make when they need funding?
Any preference for solo GPs, teams? What works best from your perspective?
Solo GPs have the key person risk, obviously, and so try to mitigate that. But, we're just looking for promising investments, but making sure that just like everything else in life, we're trying to mitigate potential risks that are in the portfolio and looking for the best risk adjusted returns in the space.
Have you ever had to convince one of your institutional clients to do venture and they were initially not interested in it and then you had to actually pitch them on it?
Me, not personally. So Tim, I think, one of the things that are good about fund of funds is you can get venture into those funds of funds and don't have to explicitly say, you should be invested in venture. You don't have to make that argument. You can just say, this is a well-diversified fund. And I think it's a very easy way to get exposure to kind of the broad spectrum of private investments and get people comfortable with venture and the other aspects of private equity there are.
You bring up a point that I didn't think about, but I'm really curious now, which is you look at so many different opportunities, including for venture fund of funds versus directs. How do you and your clients compare the two? And when does it make sense to do a fund of funds versus doing a direct into a fund?
Yeah, so we find that clients that are newer to private equity or starting their private equity program will do a fund of funds just to get them comfortable and exposed to the space. Now, obviously, fund of funds has its own headwinds of, the perceived double layer of fees, and you're just paying more for these investments than potentially you could if you were doing direct investments. But fund of funds play a very important role in, getting a diversified portfolio, lots of exposure, and reduced volatility. It's really then, if you've had private equity investments for a while, you feel comfortable with it, and then you say, we want to grow our program and we want to start taking more risks. And so, essentially we want a core strategy that might be start with fund of funds and then do some satellite investments. What do you think looks really promising? And again, it's really the risk appetite and the size of the allocations to a client that make all the difference. And so, more adventurous clients will potentially go more into venture if they see something promising. A lot of times what happens is a board member or staff member will have a strong conviction about something and can start driving the decisions for clients. Obviously, it's subject to the approval of the board, but if you have a conviction and you have a strong track record of people in the fund, that helps a lot.
So I believe we learn as much from failures we do from successes. Have you ever gotten it wrong with a recommendation, and what did you learn from it? Keep it anonymous.
Yeah, I get it wrong all the time. It's a question to just look at the process and see, what are the things that we missed or, that we didn't expect? What were the unknown unknowns, but now unknowns at this time? And how can we diversify or, mitigate those risks in the future? And so, we're human, we're all going to make mistakes. And so it's just, were there signs that we could have seen earlier? Some of the times when you get in investments like this, there are very few options for an off-ramp, but, do we have enough diversification where this will not materially impact what we're trying to do overall?
I'm now going to flip that question, Lenore. From your perspective, when you meet emerging fund managers, what are mistakes they make when they engage with you or Wilshire?
I think the mistake for all people selling funds, including myself to clients, is, just being overconfident in our abilities. Just because we've had success in the past doesn't guarantee success in the future. It's that old, CFA adage that past performance is not a guarantee of future success. And so, I think one of the most crucial parts of this job in this industry is continue to learn, continue to gather information. You don't have to do what everybody else is doing, but you need to know, what's working and what's not working and what you have confidence in going into the future.
What's working lately Any trends you're particularly excited about?
Up until about 10 days ago, large cap growth was really working. Private markets in general have been working overall. It's just, one of the questions or the headwinds facing lots of institutional investors today is, getting distributions from their funds. Are they being asked to take extensions? Obviously we've had a lot of innovation and try to getting distributions out and potential new investments such as NAV loans. It's navigating out what are the right opportunities for you at this point. Is an extension the best option for you? Or, is potentially going into some different type of investment now? Obviously, I think I'll bring up something that you aren't necessarily focused on, but, private credit seems to be ruling institutional investors' appetite at this point. It's a larger and larger portion of everyone's plate. There's been a love fest with private credit, I feel like, over the last, few years, particularly since the pandemic started. But we'll have to see where that ends up over the next several years.
On that line of private credit, my understanding, Econ 101, is private credit is interesting when interest rates are high, and then maybe when interest rates are lower, venture capital might become more interesting. Do you think that's a good read or not?
Yeah, I think private credit is very interesting when interest rates are high because you get a high base rate plus a high spread. That spread doesn't necessarily change when interest rates have changed. And so, the risk return trade-offs between private credit and venture capital shift as interest rates change.
Are there particular industries or technologies and venture capital and technology that you think are especially appealing to institutional investors right now?
I think I'm going to say something obvious. I think artificial intelligence is interesting to everybody as long as you can monetize it. And I think that's the big question right now is how do you monetize artificial intelligence? The one easy way to do that is not necessarily in your space is just data centers. And artificial intelligence is really nothing more than data being stored somewhere and manipulated. And so, that's the, adjacent play to artificial intelligence. But if someone can find, to use a Lord of the Rings reference, one artificial intelligence program to rule them all, I think that would be great. I don't think that's going to happen personally, but, there are going to be segments where some tools are better than the others. And so figuring out which tools are better and potentially you and Lenore picking those VC firms that are trying to grow into that would be great.
Within venture capital, there's oftentimes a delineation between, say, emerging, established, and recently I heard franchise. And my take on emerging is typically funds 1 to 3, established is probably like 4 to 6, and then franchise, as we mentioned, Andreessen, Lightspeed, Greylock, is probably like 7 and beyond. How do institutional investors assess whether a firm is emerging, established, or a franchise?
I think it's really just laid out the number of funds. I think the headwind for emerging managers are, you don't necessarily have that proven track record. We focus a lot of time on, we want a proven track record. We want to have a safe investment, like I said previously, and that's really hard when you're launching a fund 1 or fund 2. But, going back to what I said earlier, that really can be largely mitigated by what have you done in the past? What is your history and what are the relationships that you have? That's really how you can overcome that. You go to the mega players if you want venture, but again, if you want the bigger deals in venture, you may not get, the pop in return that a fund 1 or fund 2 has, but you'll still get something very attractive. That middle in between, emerging to the mega, I think a lot of research is spent there to try to figure out, which ones will become the mega funds, or will there be the ability for them to be absorbed or acquired by one of the mega funds. And so that's really the return opportunity there. They're big enough and they have a strategy that everyone feels comfortable with. You won't get fired if you recommend them. And if they get bought out, then it's great for all parties.
How do you influence your clients to decide how much to allocate to venture capital versus private credit versus your broader portfolio?
The easiest way, Tim, to do it is just by AUM. What's the total AUM in this market? How are you invested? What are the opportunities that you don't want to miss or that you want to take advantage of? So that's, largely market cap weighting in the private markets. And again, if you have a higher risk tolerance or lower liquidity needs, then you can move more into venture than some of the more established private equity investments.
I want to quickly follow up on that question, which is when we went out to go raise Fund One, I talked with some large groups and they're like, we don't write ticket sizes south of 50 million. And some were like, oh, we don't even write ticket sizes south of 100 million. And then there were even some family offices that were like, we don't even write ticket sizes south of 30 million. And as an emerging manager, when you hear that, you're just like, the first time you're like, wow, like clearly I need to better understand when the institutional investors will want to meet me. And so part of this question is, at Wilshire and your clients, when do you want to meet with emerging managers, and when does it make sense for them to come meet with you all?
Yeah, so Tim, we want to meet emerging managers all the time. Like I said earlier, it is that frustration that you have with a lot of investors will only want to write checks that are potentially bigger than the size of the fund that you're raising. And the other headwind is they want diversification in the funds. And so they don't want to be too big a portion of any single fund. And so that's a serious headwind for all emerging managers. What I would love to see this industry grow into is there an ability to just start essentially an emerging managers fund where we can put together, I don't know what the right number is, but several different emerging managers funds together and roll that up into one single line item that a family office who does want to write a $30 million check can do. It builds in diversification. I know that there's a lot of issues with kind of performance and how you report that out, but I think that's the way to really grow the emerging manager pool without having to be kind of that 100 million plus size fund.
Speaking for us both, we love that idea, and we have a lot of friends, Ned, that would love that idea.
Okay.
Sorry, Tim.
I think a few funds come to mind that I think try to do this, like Sendana. I think Screen Door is trying to do this. But I'm curious, Ned, do you know of any funds that are trying to do this or that do it well in venture and then in other asset classes?
I don't know of any, Tim, but would love to hear about others and potentially talk with them.
Might this be a product that you all build out?
It could be, but I don't get to make those decisions. But I think that is, as I've, looked through the emerging manager landscape over the last several years, I think, to really get the size that's needed for large institutional investors, we need to build a fund where they can invest in a lot of emerging managers like yourself without having to worry about check size. I think that's the frustration that a lot of emerging managers, both diverse and non-diverse, have at this point.
That's what I was about to ask about next. So I think there's obviously a great many diverse and underrepresented GPs, particularly in that emerging manager category. I think we've seen the pendulum swing a little bit over the past few years in terms of interest in funding those managers. Any thoughts from you about supporting that particular population?
I would love to do more support of it. I think a lot of large institutions have emerging programs, but there's frustration that their check size is too big. And so there seems to be a plethora of family offices these days looking for other ways to invest their money and get potentially outsized returns. And so I think that, that potentially is an avenue to be able to grow and to be able to get the bigger size funds at this point. Or maybe, also another area to go into is kind of the smaller endowments and foundations that institutions have. A lot of the smaller institutions, I would say, have an emerging program or emerging a diverse program, especially for endowments and foundations. And, they're not writing the check sizes that a lot of the large public pension plans have. And they do have a dedicated sleeve to firms like you all.
Where do you think we are in a macro cycle for venture? Meaning if, say, hedge funds is fully matured, buyouts is pretty mature, or your clients have a lot of exposure to. For venture, do you think they still have a lot more to get into, or do you think they're pretty much there and now they're fine tuning it?
As assets grow, everything's going to grow. And so I think there should be more room for venture at this point. There seems to be kind of this explosion of innovation at this point. I'm not sure I want to call it a revolution, but we are in this AI wave right now. And so I think there's a lot of opportunities for new products that most of us haven't thought about, at least that I haven't thought about, maybe you all have, that will change our lives over the next, decade or two. I think it's, if you were to ask most of us, 5 years ago, would we be coming out of a scenario where all of us worked from home for a couple of years and didn't see each other? I think all of us would have said there's no way that was happening. But look at where we are today. It's a completely different world than it was, just 5 years ago, right before 2020.
Are there certain funds or firms or fund of funds that you think do it really well that emerging managers should, and all managers should look to emulate? And if so, what are some of their best practices?
Honestly, I don't know of any. None of them come to the top of my head. I think it's everyone's trying to do their best job, and it's just a question of where the opportunities come and that you can find.
Do you and your team ever give feedback to fund managers on their pacing or how long their funds are between when they come back to you? And associated with that question is, when you all back funds, do you all think of it as, we're going to back this one and pretty much default back the next one? How do you all make those assessments?
Yeah, I mean, if the returns are good, Tim, we'll back you in your next fund. If there's no red flags or any reasons for concern, it is human nature just to do the same thing over again. And we as investors tend to do that. And so, unfortunately, it is critical to have a good performing fund once you get in with an investor. But I think we're all trying to raise great funds and invest in the best funds. And, while past performance isn't a guarantee of future success, it's, fairly good indicator that if someone's had success in the past, that they will have success in the future.
And is one of the ways that I've heard to get to certain decision makers is you actually first get talk to the underlying institution, and then if they have a consultant, they connect you with them, as opposed to going through the consultant. What do you think are best practices, or it really doesn't matter on approach?
I think you have to use all approaches, going through the consultant and going to the end investor. I will say, I think that going to the end investor can get you to a quicker path, because if someone is very convicted and wants to invest with you, then it forces their consultant to, look at you more closely. And once you get in with that consultant, they have a lot of other clients, obviously, that they can potentially invest in. But, it's a multi-pronged approach, and it just takes a lot of outreach and time to talk to all the various parties.
Now, this one's maybe a little more personal, but I'm just kind of curious. You've been at this for a while now. Starting in 2008, you've now seen a real cycle. Like, what still excites you about what you're doing every day, about your job, about the recommendations you're making? Yeah, what's exciting for you? What keeps you doing this?
Lenore, it's just a continued learning process. So, when I started working in the investment industry in 2008, obviously we had the great financial crisis. It was a great time to learn. It felt like drinking through a fire hose. Then it slowed down a little bit. Going through the zero interest rate environment, really expanded my knowledge of other fixed income products other than the Barclays Ag, as clients were looking for yield. And so I feel like we've gone from about one or two, standard fixed income investments to probably 10 to 15 at this point that all investors look at. Now, with the rise of private credit, it seems, and just private investments in general, it seems like this is a new landscape. And so what keeps me going is the continuous learning that you have to do in this industry to stay relevant and just be able to talk with clients. And it's interesting to me, how things change, but, it's always good to have a little perspective of past history, but be open to knowing that, the future isn't going to be the same as the past, but there are things that you can learn from the past to help you in the future.
Any predictions that you're willing to make for the coming year?
For the coming year, I don't like to make short-term projections to tell you to be honest, but if we just think about kind of past history, or I look at past history, there was a point in time where everyone thought the baby bells would never die. Half the people who are listening to this podcast have no idea what the baby bells are, so I would encourage you to look that up. We all thought IBM would be a company that lasts forever. IBM used to be the maker of a lot of desktop computers, but they no longer really make desktop computers. And so just knowing that everything's going to change and things that we think are a sure bet today that will last forever, just have humility and know those things will most likely change in the future. So maybe that's a long-winded way of saying I don't know if the Mag 7 will retain their great powers that they had in 2024 in terms of return, if that will repeat itself. They'll probably do very well, but will they repeat what they did this current year? I doubt it.
You said you tend not to make short-term predictions. Do you like to make long-term predictions? And if so, any thoughts on that?
Well, Tim, I'm gonna give you a quote from one of my actuarial exams. And one of the exams, one of the questions that I had to study was, write the, 7 weaknesses of models. I don't know what those 7 weaknesses are anymore. I just know that one of them, all models are wrong and some models are useful. And so whatever crystal ball that I look into has cracks in it. And so I think longer term, I would say that public equities, especially U.S. equities, probably aren't going to outperform non-U.S. equities to the degree that they have over this past several years. It's kind of been astonishing how far ahead U.S. growth has been, even relative to U.S. value. At some point, one would reasonably expect that value would start to outperform growth. We've seen a couple periods of that, but over the long run, I would assume that they will equal out in terms of returns. Will that be 1, 2, or 5 years? I would guess that it's going to be more like 5 years because value is starting from such a deficit versus growth at this point. And the same could be true with non-U.S. equities too. I think one of the things that isn't spoken about a lot is what are the demographic changes in the developed world going to do with respect to investment returns. We have, essentially a declining population in most of the developed world and also in Asia at this point. Outside of India, most of those countries' populations are going to fall tremendously. And so how does that change the economies going forward? I think that's the hidden risk or the hidden trend that, is not talked about enough these days.
I want to quickly pivot back to venture, and I have 2 questions here. One is, how often do you or your clients get involved with their sharing or pushing venture fund managers on portfolio construction, on how much you all think how many investments they should be making in a fund, or the percent of follow-ons versus non-follow-ons?
Tim, I feel like clients only start to talk to funds when they're not doing well. If you're performing well, they just kind of stay in the background and they ride the returns. Lots of them will want, I think all of them will want updates, but, there's not a lot of concerns if the investments are performing as expected. And, I'd say that's true for the consulting landscape too. We try to pride ourselves on doing the due diligence to making sure that we've picked the strongest managers that we can within the sleeve of the portfolio that we're trying to fill.
Are there any misses that you all wish you all could have done in terms of like, hey, we saw this fund and we had some concerns and maybe we should have gone ahead with it?
Yeah, there's always some of those. We've had some phenomenal failures that we wish we could have back. And, to the points made earlier, it's just a question of learning from what happened, what did we miss, and what could we have caught earlier? Was this kind of a black swan event where nobody was expecting it and we were just unlucky?
And then on timing, what's the longest and shortest you've seen an engagement and then a close?
I don't have exact lengths, but, I think if everyone I think we we tell our clients, it's a 5 to 7 year investment period. I think we're starting to see some funds last well beyond 7 years at this point, just due to lack of exits. But essentially the shorter the better, so you can get your money back and potentially a high return. But too short can be an issue too.
That's in terms of the returns and liquidity back to the investors. I'm curious, actually, in terms of the engagement with Wilshire and your clients, the first engagement and potentially an investment or a close?
I would say that the discussions and the due diligence questionnaires, at the various quickest would take a year. So again, this is a long-term relationship that we have to cultivate, and it's really getting to know each other. To put it in relationship terms, I feel like getting into a fund is like a Hollywood marriage. They're expected to last 5 to 7 years. Some last longer and some last shorter. And so you really want to make sure that you do a lot of work to make sure the next 5 to 7 years are going to be great for you.
And so 1 year, it sounds like, is the shortest. What's the longest someone has wooed you all to get into this Hollywood marriage?
10 years.
That's incredible follow-up and resilience.
Yes, and that's just my experience. And they were very appreciative after the 10 years, but, just it has to be the right time and the right place, just like everything else in life.
To use a Hollywood analogy, it seems like they probably had a few films under their belt before you all were greenlighting a major film.
Yes, we need to know that you had a few blockbusters and were able to recover from the ones that weren't hits.
Nice. We have some rapid fire questions to close out the podcast. Who are some leaders or a leader you really admire, historic or present?
Say my parents and a lot of the teachers that I have, especially the high school teachers that I had.
Can you elaborate more? Maybe was it because you were a difficult high school student, or you just learned a lot then and it really set you on a path to success?
I would like to say I was a perfect high school student, but I know I wasn't that. It's the ones that spent time with me to help me with some of the things that I struggled with, but also, ones that really inspired me to do better and really achieve what I have up to this point. There were things that I struggled with at high school that I feel like I'm now very good at. And, I was a math major in college, but one of the biggest inspirations in high school is my 9th grade geometry teacher. And so, even though I knew I was interested in math, he pushed that interest up even further for me.
So true. In fact, I quickly want to call out Mrs. Willis, Mrs. McLean, Mr. Cowdery, Mrs. Wahlberg, and Mrs. Lemley for dealing with me as a high school student. Speaking of movies, what are some of your favorite movies?
I'm a child of the 80s, Tim. Well, I was born in the 70s. I'm the youngest of 4 siblings. And so I love the 80s movies. So Top Gun was probably my favorite, action movie from the 80s. And who doesn't love The Princess Bride? It has a little of everything, just like they said.
I've been watching a ton of 80s movies with my son because I feel like they're just more age appropriate. So we've seen Gremlins, Gremlins 2, Airplane, ones that are just funny and age appropriate. How about favorite books, whether they are industry books or leisure?
To be honest, I try not to read a lot of industry books. I feel like I read enough white papers to figure that out. One great book that I'm reading right now is Tomorrow, Tomorrow, and Tomorrow. It's a great story. It has California history to it, so that's very interesting to me. It deals with video games too, so the young kids might want to read it too.
Speaking of video games, any favorite video games?
I had an original. I played on the original Nintendo, which just had the A, B buttons and the four up, down, left, right buttons, and so who doesn't love kind of the original Super Mario Brothers or Mario Brothers at this point? Maybe I'm dating myself. Yes.
70s baby, grew up in the 80s too. Yes, I beat Mario Brothers.
Tetris was, a favorite when you got the Game Boy and just ran out the batteries, trying to figure out how to do that, how to get up higher and higher.
And our final rapid fire question, any favorite travel spots?
Despite the fact that I live in Southern California, I love beautiful beaches. I think the most beautiful beach that I've been on is in Saipan, which is just north of Guam. Great history there if anybody is interested in learning about history in World War II.
Awesome. This has been really fascinating. Love the analogy between venture capital firms and Hollywood marriages, how one manager took a decade to woo you all to get your capital. That's inspiration for us emerging managers. Ned, happy holidays. Thank you so very much for taking the time to chat with us.
Likewise, happy holidays. It was great speaking to you.